But how exactly do they do it? And what strategies do they use? In this video, we'll dive deep into the world of investment strategies, focusing on how the affluent are investing in commodities across the globe. Traditional investment strategies focus on diversifying a portfolio across various asset classes like stocks, bonds, and cash to manage risk and achieve steady returns. These strategies often rely on a long-term, buy-and-hold approach, where investors choose assets based on their risk tolerance and financial goals, holding on to them through market ups and downs. Stocks are typically chosen for their potential for higher returns, while bonds offer stability and income. The emphasis is on minimizing risk through diversification and maintaining a balanced portfolio over time, rather than frequently buying and selling to capitalize on short-term market movement. Commodities are any useful or valuable things, especially something that is bought and sold. Commodities such as gold, oil, and agricultural products play a crucial role in a diversified portfolio by providing a hedge against inflation and market volatility. Unlike stocks and bonds, commodities often move independently of traditional financial markets, offering a way to reduce overall portfolio risk. Their value is influenced by supply and demand dynamics, geopolitical events, and economic shifts, making them a valuable asset class for balancing risk and enhancing returns. Including commodities in a portfolio can help investors protect their wealth during periods of economic uncertainty and benefit from price changes driven by global trends. Commodities are typically divided into two main categories: hard and soft commodities. Hard commodities are natural resources that must be mined or extracted, such as gold, silver, and oil. These are often used as raw materials in industrial processes and are considered valuable for their role as inflation hedges and store of value. On the other hand, soft commodities are agricultural products or livestock, like wheat, coffee, and cattle. These are primarily used for consumption and are more sensitive to weather conditions, seasonal cycles, and agricultural practices. Both types of commodities can offer diversification benefits to a portfolio, with hard commodities often providing stability during economic downturns and soft commodities offering exposure to global supply and demand shifts. Commodities are traded through various methods, including futures contracts, spot markets, and exchange-traded funds, ETFs. Futures contracts are agreements to buy or sell a specific amount of a commodity at a predetermined price on a set date in the future, allowing traders to hedge against price fluctuations or speculate on future prices. The spot market involves the immediate purchase or sale of commodities for cash, with delivery taking place right away, reflecting the current market price. ETFs provide an accessible way for investors to gain exposure to commodities without directly owning them, as these funds track the price of a commodity or a basket of commodities, offering a simpler and more liquid investment option. Commodity prices are influenced by several factors, including geopolitical events, supply and demand, inflation, and currency fluctuations. Geopolitical events, such as conflicts or trade disputes, can disrupt supply chains and affect availability, leading to price changes. Supply and demand dynamics are fundamental, with prices rising when demand exceeds supply or falling when supply outstrips demand. Inflation affects commodity prices as rising costs of goods and services typically increase the value of commodities, which are seen as a hedge against inflation. Currency fluctuations also impact prices, especially since commodities are often priced in US dollars. A stronger dollar can make commodities more expensive for holders of other currencies, potentially reducing demand and lowering prices. The wealthy often invest in commodities to diversify their portfolios and hedge against inflation and economic instability. They typically access commodities through futures contracts, allowing them to speculate on price movements without holding the physical asset. Many also invest in commodity-focused exchange-traded funds, ETFs, or mutual funds, which provide exposure to a broad range of commodities with greater liquidity and lower transaction costs. Additionally, some wealthy investors may acquire direct ownership of physical commodities like gold or real estate holdings rich in natural resources, offering both a tangible asset and a potential hedge against market volatility.